The only thing I would do differently that comes to mind is just start a lot sooner. I tell myself now that, Clive, you didn't need to work in corporate America for 20 years before making this pivot and transition. And even while I was working, there's more that I could have been doing to make for a smoother transition out of corporate into this. And so it's really comes down to timing and some of the smaller things that I was doing.
Josh Appleman, founder and CEO of Appleman Properties. Today we're joined with Clive Davis. Clive has went from corporate to the real estate entrepreneur. Clive, if you could, let everyone know a little bit more about yourself.
Yeah, thanks, Josh. Thanks for having me. Yeah, so background, I started out as a corporate transactional lawyer with a Wall Street firm, New York City, right out of law school. So I did that for several years. Transitioned into the pharmaceutical industry and became in-house counsel for a pharma company there in New York, and then relocated to Atlanta, and a couple of years thereafter became a chief compliance officer for a different pharmaceutical company. So all in all, a 20-year corporate run. And at the end of 2016 is when I made the decision to exit and make my escape from corporate life and pursue real estate investment full time. And so that's the journey and path that I've been on since. I did invest in real estate throughout those 20 years as a small landlord, mostly with properties out of state, but nothing on the scale of what I would embark on after leaving corporate at the end of 16.
Got it. That's incredible. So you realize the value of real estate, getting in and taking action and getting things going. So tell us about your first deal, how you found it, how you financed it, took it down, and managed it, and just the entire experience.
Yeah, I'll talk about the bigger stuff.
Yeah.
So the first deal, once I decided I was going to pursue this, I submitted my first offer on a 92 unit in spring of 2019. I didn't get that one, and I thought, I didn't get that one. We didn't want to pay $300,000 more. Someone else did. They got it. I figured I'd get a deal in a month or two. Fast forward to summer of 21 was when I landed my first deal. So this is a publicly marketed deal, 244 units here in Atlanta, which is home for me. And we ended up closing on that in late 2021, 244 units we acquired for just under 30 million. And we raised about $8.25 million in equity. So that was my first deal, which took me from 5 units, which was as big as I had gone as kind of a small landlord, all the way to that 244 unit for the first deal.
So how does that happen? How do you go from 5 units to 200 plus? Tell us the part that we're missing.
Yeah, so there's a lot that's missing, including a 2-year journey of knocking on doors. But basically, when I sold that 5 unit I actually sold that 2 weeks into COVID. So I sold that at March 31st of 2020. And I just decided I wasn't going to do anything small. I wanted to get into big stuff. And so what I had started doing even before that was invest in my retirement related funds through a self-directed IRA into 100% commercial real estate deals, mostly multifamily, large scale multifamily deals as a passive investor. So that was part of my journey. And beyond kind of the expected ROI, I was also trying to get some insight into how do these deals get put together? What do the business plans look like? What's the capital stack look like? What's investor relations all about? And so always with a view to what kind of a sponsor of these deals am I going to be, whether that's a year from now, 2 years from now, whatever the case was at the time. So that was part of my education. Another part was just getting out there and putting myself in a position where I was surrounded by people who had an interest in large-scale multifamily real estate as an investment form. So attending multifamily conferences, listening to podcasts like yours and others, just getting out there and really jump-starting my education, and really, I jokingly refer to it as a self-directed real estate MBA, because all of those things coming together was what served as a foundation for me to get into this space. And then the last piece is I joined a mentoring program, an apartment investing mentoring program that put me in proximity with people who were all in on multifamily. That was the place where I found my partners. And to some extent, that's where I found some of my passive investors in the deals that I'd go on to do. So again, even when I had all that in place, I was still knocking on the door for the better part of 2 years before I landed that first deal. And during that time, I'm developing relationships in my market, or my target market, which is the Atlanta Metro. Again, that's home for me. Developing relationships with brokers, touring properties, positioning myself for that first deal.
Yeah, that's huge. And then once you get into the room with other like-minded people in a mastermind, it gives you the confidence to be able to go out there and take a 200 plus unit property and put it on contract, and the confidence to raise the capital. There's components to learning. You have to learn the language, understand how to underwrite, and understand the deal if it is even a deal. And then there's a whole nother component is conveying that deal to investors that could potentially want to invest, and that takes years of training as well. So it's sounds like you had to fast track by just getting in the right room around the right people.
Well, you learn very quickly that when you're doing deals at this scale, it's a team sport. So even folks that have the wherewithal to do it by themselves would be crazy to try and do it by themselves. And so very quickly you realize it's a team sport, and you just got to figure out, do I build a team from scratch, or do I associate myself with a team that's already, has a track record, is already doing deals that I can add value to? And so once that light switch goes off, you kind of pivot from the mindset of, I can only do deals based upon what's in my personal savings or bank account.
Yeah, and that holds you back. It's ultimately you have to keep your cup filled in order to do another deal. And in real estate, the cup is always wanting to empty out on new deals. So it helps bringing partners in, bringing investors, and everyone wins together, and taking down more great deals together. So you got your first deal done, and then ultimately that gave you the catapult to do a second deal. Is that correct?
It did. And so you've heard of the law of the first deal, right? So I told you about knocking on the door for 2 years. We got that first deal. We closed early November of 2021. The week that we closed on that, I got a call from Cushman saying, "Congratulations, Clive, you've been awarded a deal." Happened to be about 4 to 5 miles away from that first deal, 200 units, a $40 million deal. And so we ended up closing that 3 months after. So all of that work and effort that I had been putting in for 2 years was finally starting to pay off, and I was finally starting to gain some traction. And once you've got one deal under your belt, you are now a proven commodity in that space. And so people are going to look at you with a lot more seriousness than when you're a wannabe owner of large-scale multifamily. Once you can say that, no, I'm a current owner and I've successfully closed on a transaction of comparable size, now you start getting taken seriously, and it's a different conversation than I was having for those 2 years when I was just saying I want to be versus I am.
Yeah, absolutely. That just gets everything going. So what's next on the roadmap as far as projects, and then of course we're dealing with the market and today's craziness. What's next?
Yeah, well, we're all bobbing and weaving and navigating the market reality that is today. We're all paying attention to what's happening with interest rates and rate cap pricing and all that good stuff. We happened to just close a deal at the end of June 30th. We closed on, it's actually the largest transaction I've been involved with. We acquired a 295 unit in Arkansas, Northwest Arkansas, for $77 million, raised $38 million in equity for that deal. So to pull that deal off in this environment with all of the noise that's out there, I'm super proud of that. I was one of many involved in that transaction. So we're fresh off of that one. But what's new for me, or what's happening for me, is I've gotten into a couple of development projects. And I always knew that it was a natural evolution to get to development at some point. It probably found me sooner than I planned for it, but it's all good. I'm involved with two developments. One really heavily involved with one other partner, and that's a 90-acre development southwest of the Atlanta airport. It's a mixed-use community, culinary-centric community that we're developing. And within the next 2 weeks, we should have our land disturbance permit fully approved, and be looking at breaking ground in probably late October, early November. So that's exciting. That's consuming a lot of my time. I'm drinking from the fire hose in terms of what I'm learning, because development, as you know, Josh, is a very different animal than going out and buying an existing asset that's already up and operational.
Yeah, developing is it's a grueling process. It's there's no satisfaction until it's actually done, and that could take years. But after it's done, it's great. It's just going through the motions. It's you're ups and downs. Get approvals, get the architectural engineering, the whole 9 yards. How do you get involved with a deal that size? How does that come about?
Yeah, so like I said, it kind of found me, but I would say it came as a result of networking. And I tell people that I kind of boo-hooed networking when I was in corporate life for the 20 years. I didn't necessarily see it as being critical to my day-to-day success. When you get into the space of real estate, commercial real estate, you realize that without networking and developing relationships, you're dead in the water. So as a result of networking, a mutual friend of mine and my now partner on this 90-acre development said, "Hey, Clive, you should meet Dominique. She has this vision for this culinary-centric community. She's the former, she started the Atlanta Food and Wine Festival, and this is her latest venture." And then said to her, "Hey, Dominique, you should meet Clive. He's this multifamily guy, has this interesting background, et cetera, et cetera." So we hit it off. We meet a few times. I and my spouse, my wife, meet up with her and her husband. Again, we cement the relationship, and just ultimately that grew to the point where we both agreed it would be a great idea for us to develop this project together and bring our respective skills to the deal, to the opportunity. So that's how that came about. And like I said, it came as a result of networking and a mutual friend just connecting us.
Just being in the right rooms. That's what it's about. And
yeah, you
real
got to put
estate.
yourself out there.
Yeah, for sure. Absolutely. What areas, you said Arkansas, what other areas are you all underwriting for?
Yeah, so if it's a deal that I'm taking the lead on, I'm primarily focused on the Atlanta Metro as my target market. I'm not actively looking outside of this market. The only reason I looked at that deal is because one of my partners on my earlier deals has ties and connections to that market, and had been trying to get into that market since 2019, and finally was successful in landing a real quality asset, compelling submarket. And I was one of the folks he reached out to and said, "Hey, do you want to join me in getting this deal done?" And so, again, if it's a partner with whom I have a solid relationship, I'll take a look. But I'm not out there beating the bushes in these markets, where I haven't kind of put in the due diligence, put in the time, developing relationships, and all the things you need to do if you're trying to break into a market.
Yeah, I think that's a big takeaway. Is he reached out to you because he knew you could bring value to the deal in whatever capacity that may be, whether it's raising capital, asset management, boots on the ground, just a part of the general partnership to add value to make sure that the deal is the plan gets executed. How would you suggest someone out there that may be listening get involved with real estate and find out how they can add value?
Yeah, so I mean, everyone's got to do a self-inventory of kind of what do I bring to the table? What value can I potentially add? And the beauty of commercial real estate at this scale is that there are so many roles, so many hats that can be worn. And so, you may have a strong network that you can tap into. You may be kind of an outgoing, extroverted person who could take the lead on investor relations. You may be the boots on the ground if you're in a market that's a desirable market that others are trying to get into. You got to figure out what is your advantage. So early in my journey, I basically said, I'm not trying to compete in, Dallas, Fort Worth, great market for multifamily, but I don't necessarily bring anything of value to that market. It's heavily competitive. I'm not boots on the ground. I don't want to be boots on the ground. I don't want to be flying into Dallas to babysit deals. And so I said, I'm going to compete here in my backyard, strong multifamily market. I can then position myself with people that I'm meeting and networking with. I can then position myself as boots on the ground with developed and established relationships. And, once we get the deal closed, I'm going to be naturally the person who's going to take the lead on asset management and the relationship with our third party property manager, all of those things that need to be done, from an asset management standpoint to ensure our business plan is getting executed. So just selfishly, I've chosen to focus primarily on my market here in Atlanta. And, again, if it makes sense outside and someone that I know and trust and want to work with and partner with, I'll take a look at those opportunities, but I'm not out there beating the bushes for them.
Yeah, no, I agree. And where focus goes, energy flows. And if it's your hometown, then you can dominate your territory just by knowing the area and even knowing what's up and coming in the area, just better than anyone else. Just being in the know. That's smart. And you live in a great submarket. I mean, the MSA is huge, or not submarket, the MSA in general, Atlanta. So
it is. I mean, when I moved to Atlanta in 2005, the metro had a population of 4.8 million. Today, I think it's 6.2 or 6.3 million, and continuing to grow. And that only accelerated with COVID's arrival and onset. And, not only is it a strong market, in the last year or two, it's been a strong market for more than a decade. And so, I think it's going to continue to benefit from corporate relocations. We continue to get our fair share of corporate giants to add to the roster of the UPSs, the Home Depots, the Mercedes-Benz of North America, the Porsche of North, all of these companies that are household names. Yeah. We continue. Microsoft has a substantial presence that it's growing here. So I think all of that bodes well for the metro on a go-forward basis.
Yeah, for sure. If you had to start over, what would be your route? What would you do?
The only thing I would do differently that comes to mind is just start a lot sooner. I tell myself now that, Clive, you didn't need to work in corporate America for 20 years before making this pivot and transition. And even while I was working, there's more that I could have been doing to make for a smoother transition out of corporate into this. And so it really comes down to timing and, some of the smaller things that I was doing, I would have made more of a concerted effort to figure out the pathway to larger scale deals sooner. But outside of timing, there's not really a lot that I would change in terms of what I was actually doing.
Yeah, that's good. If somebody's listening, they want to get started in real estate and they're not sure which direction to take, how would you tell them to educate themselves and a path they should take to get to where you're at?
Yeah, so I'm a big proponent of mentorship of whatever kind. Mentorship, from my standpoint, when you decide that you're going to be mentored and someone's going to mentor you, it should compress timelines. So if it would take you, let's say, 3 years to figure it out, kind of trial and error on your own, kind of knocking around, you get with a mentor, it should compress those 36 months to 12 months. So I'm a big proponent of get with someone or get around people who have done what you're trying to do and have them share their experience, impart their wisdom, and help you navigate that journey. There's no need to repeat mistakes that others have made. You should be thinking about, how can I get to my destination in the shortest amount of time? And from what I know, the best way to do that is to get with someone who can hold your hand and guide you and get you there with the fewest number of kind of detours and diversions.
Yeah. Yeah, that's huge. What about books? Have you could you suggest some books for the listeners to read?
Yeah, so there's one that doesn't go too far from me, and I'm going to shamelessly plug it. The Best Ever Apartment Syndication
Yeah.
book. I've probably recommended this 3 dozen times, by Joe Phillips and Theo Hicks. Great book, kind of gives you the A to Z's of how you do these deals, what you need to do. And so I highly recommend that. And my copy, I've kind of listened to the accompanying podcast that goes with it, but I also terrorize the book too. But that's one I would recommend if you're serious about wanting to get into the space and viewing and syndication as the way to do it. That's a solid book.
Would you say it's worth the effort to go through all the motions of learning and the mentorship? And I mean, it takes years to get to where you're at. Years of knowledge. Is it worth it?
Absolutely. I mean, everyone, you've got to determine what's your why.
Yeah.
If you set out on your journey and and you're kind of, you don't know what your destination is, you're going to run out of gas eventually.
Yeah.
So you got to start with, where am I trying to go? And once you determine where you're trying to go, and for me, it was all centered around kind of personal freedom and being able to create generational wealth and a legacy for my family. Something, give my family and those coming after me generationally more than I inherited. And I think that's all of our responsibility. So for me, although I was in a very good situation, well compensated as a corporate executive, I tell people that I don't care how high your W-2 income is, you cannot pass on a high W-2 income to your heirs. It just doesn't work like that. As soon as you stop showing up for work, or as soon as they no longer have a use for you, that income stream stops dead in its tracks. And so for me, I wanted to reclaim my personal freedom. I didn't want anyone to be able to tell me when I could go, where I could go, and when I needed to be back. I just wanted to reclaim that personal freedom. And I'm using that personal freedom to create that generational wealth and legacy for my family.
Yeah, that's huge. That's huge. And having the onset to know what you're going after and reaching goals. That's huge. If somebody wants to get a hold of you, how can they reach out to you?
Yeah, I'm pretty active on social media, Instagram, LinkedIn, Facebook. But the best way for anyone to reach out and get a hold of me is just going directly to my website, which is parkroyalcapital.com. And you can book a call with me. You can connect with me on the various social media platforms, and as well as sign up for my newsletter.
Very cool. Awesome. I look forward to following you. Appreciate the conversation. We will certainly talk soon. Clive, I appreciate it.
Continued success, Josh.
Yes,
Thanks
sir.
for having me
Absolutely.
on.
High five. Thank you. You've got an awesome history, and you're still super young, 35 years of age. Touch on your first deal and what got you into real estate and apartment investing.
Oh gosh, the first deal, that was a while ago. Well, look, I mentioned I'm a third generation real estate investor. So the first thing we tried to do was replicate what we already knew, Josh, and that was single family investing. So, my family, unbeknownst to me as a kid, I worked on them. I just didn't know we owned them. Had about 70 single family houses in Central Texas. And look, it wasn't until I was getting involved with the business that I realized, well, gee, this is pretty inefficient. It costs a lot of money to maintain these things. One broken air conditioner can kill the cash flow on one of these houses for the year, things of that sort. And further, single family houses are not really valued based on the income they generate. They're valued based on, what your neighbor's willing to pay for it, the sales comp method, period, the end.
Yeah.
So, after trying to replicate what we had in Texas in the state of Tennessee where I am, and miserably failing because, unbeknownst to me at that time, I also was not a student of economics yet. And, the Nashville and Middle Tennessee market had really started to take off and become an epicenter for economic growth. And so there really just wasn't much cash flow opportunity in that area. And so, after doing a lot of research and looking at supply and demand and economics and asset types and figuring out the benefits and drawbacks of each, we settled on growing into multifamily, because back in the late 2010s, it was pretty apparent that we had a huge shortage coming out of the Great Recession of supply versus demand of rental housing, which is starting to reconcile itself a bit, but we're still a ways away from that. And we decided to buy an apartment building. So that was it was in a secondary market of Tennessee. I love the secondary markets. We can talk about why that is. But this was in Knoxville, Tennessee. Actually, I'm a UT volunteer, so this was my alma mater. I knew the town very well. And, we bought a really nice, unique building. The story was this architect lived up on a hill and had a nice house. It was 35 units. This was the 35th unit. And every, 10 years or so, he would just build himself an 8-plex around his land. And so by the time he sold the building, he had 34 rental units across 8 different buildings. And he had, his house, of course. So we buy this place, and it was an amazing first deal, Josh. The basis was good. We had the opportunity to claim about $300 in upside. We thought it was 2 at the time, turned out to be 3 over the last couple of years. It's actually just about to sell, so it's a little bit nostalgic. It's one of the smaller buildings we have, so we're kind of going. Even today, it's going to be a great exit based on the basis we bought it at. And that just puts some cash in the coffers, for whatever distress may be coming. But I think in 2 weeks, it's August 31st, by 9/15, that should be sold.
Nice.
So we bought that at $2.6 million. I believe it's selling for just under $4 million, about 3.8, 3.9. I forget the number. But it was a great basis increase, and I think the best part about it, the reason it was such a great deal for us, was the basis was great, the upside was great. It was a good way for us to really test our chops in the value add space, because it was small enough where you can get your head around it. It's not like a 300 unit building, but also it was built by an architect. It was thoughtfully built for maintenance. Like literally in the middle of these 8-plexes was this huge chase. There's a door on the back of them, and you'd open it up, and he built this massive chase where like all the plumbing is, the hot water heaters are. So it was just a maintenance man's dream,
Wow.
Just how well this thing was built. But yeah, that was the first one, and it's done very well for us.
Nice. That's and it's the first one, so now you're going full cycle, and then I could see where it could be bittersweet, because that was your baby at first, and it kind of
That's
first
right.
deal is always the most important deal, because if it fails, the industry fails for you, it doesn't work, and everything you've heard is not true. So the first deal, for it to be right, and it generates returns and it cash flows, now you build confidence, and that's confidence to get to your next deal and do it again and replicate.
Well, that's absolutely right, Josh. And I think, the good thing is that's not the first deal we've sold, right? We've sold 8 before that. But we really didn't intend to sell it. It was such a good little project, and we didn't syndicate it. It was our money. We bought it.
Yeah.
We bought the first one just with our money to test it out. And, we plan to hold on to it, but with shifts in the market and the fact that it would still exit well, we've decided, look, at some point you have to put cash back in the coffers and get ready for new basis. And so that's what we're getting ready for now.
That's what I tell my team too. You got to keep the cup filled, keep filling the cup up, because cash comes out. You have cash in, cash out. You gotta fill your cup up. Sometimes that requires selling a property to position yourself to take down a better, bigger deal. But we did the same thing. We our first complex is 33 units, bought on our own to prove it out. We were our biggest liability, because ultimately we were our own investor. So if it didn't work, we were failing ourselves. Thank God, like you, we bought it at a great basis, and the thing is cash flowing still today. I say we're going to hold it forever, but when the time comes, the time comes. But first deals are super special and super important to make sure you do them right and buy them right. What was your transition like from first deal to knowing that you want to start syndicating?
Yeah, that was kind of an accident. So, like I mentioned, we started off kind of replicating the family business, right? And then we decided, well, this asset has a little more economies of scale. If I have a repair, I'm not sending my maintenance man out to one of 70 houses that all look different and all have different parts, right? I'm sending him to the storage shed to grab one of the 35 parts we have on the shelf and go fix the part, right? So it's like you get scale in this way. It made a lot of sense. So after it went pretty well, we started getting questions, and those questions are like, hey, it's kind of cool what you're doing over here. How can we be a part of it? I'm like, I don't know. Let's go look. Let's figure it out. So we discover this thing called the SEC, and I don't mean the Southeastern Conference for football. This SEC is a lot scarier, and depending who you ask, I suppose. But the Securities and Exchange Commission have a lot of good, rules and regulations and laws around, how raising capital works. So we kind of figured that out. And our next couple of deals were very, very small syndicates, like maybe, 4 or 5 investors, and we're talking, 1 to 5 million purchases. So these are not big projects. And that naturally evolved as we gained traction. And now we do syndicate the majority of our deals and kind of augment our own capital with that.
Got it. And that was a journey where other people seen what you're doing and they wanted to come and sit around your all's campfire that you're building as well. And
pretty much. And I guess what I'll tell you folks is, look, whether you want to syndicate or do your own deals or whatever it is you're doing, if you're investing or doing something cool with your life and all that, don't hide it. The world deserves to know about it. Yeah. And just, like, even if you're just going to be Pace Morby and put videos out there, if you want to teach or if you want to do podcasts like this, talk about it. Because just talking about it attracts the people you want to be around, and that you never know, that might turn it into, a service for you, or you may just, meet a bunch of investing partners that you want to work with, or may just bring value to somebody else's life. But yeah, you have to talk about it,
The cool thing with real estate is that there's so many different ways that you can make real estate work, and each buyer is different with their thermostat of what they want to do. And by putting out information, each person might receive that information a different way, and it might change the trajectory of what they're doing or where they're going. So just talk about what you're doing, get it out there, and if it resonates with somebody, then it works, and you don't even necessarily need to know that it resonated. But totally,
yeah, that's right, Josh. And I mean, look, folks, saying you're in real estate is like saying you're in medicine, right? Like there's so many different types. Like there's, okay, are you in orthopedics? Are you a heart surgeon? Are you a general practitioner? Are you what do you call the skin doctors? Anyway, all that's clearly I'm not in medicine, but it's like same thing with real estate. Like if I say I'm in real estate, it's like, oh, okay. Are you, do you sell houses? Do you own investment real estate? Is it apartments? Is it office buildings? I mean, do you build? There's all sorts of stuff. And the only way you're going to really connect with those who may be either advanced or less advanced, more advanced or less advanced than what you are, and where you can either receive help or get help, is to talk about it,
Yeah. What would be the biggest lesson that you've learned so far in your journey?
Wow. Real estate is not for the faint of heart, folks. And so I'll tell you that, and I'll always encourage education. People balk at gurus and stuff. I'm not a guru. I don't have courses, but what I would recommend is, look, people are out there, charging money to teach stuff, and it's typically good stuff. Like, I mean, we went to every single boot camp, mastermind, anything we could get our hands on, read books. And the whole point about it is make sure you learn the lessons that will end you if you mess those up, right? And you at least get that 60 or 70% of knowledge. And then the other 20, 30, 40% of the knowledge, you're just going to learn by school of hard knocks, because the world is ever changing and things of that sort. So I say all that to say that, I think my biggest mistake in real estate has been trusting lenders a little too much, and I think, we're experiencing some things right now that we're in a 50-year debt cycle event. The way banks and lenders are acting is really bizarre and unnatural. And so, I think one of them is we will never again, trust a bridge loan to hold our construction budget and then, give it back after we spend and prove we spent it. And the reason I say that is there was a time where that was, it was always painful, but it was, relatively painless compared to what it is now. It would took, 2 to 4 weeks to get a construction draw released. Now the problem is with valuations kind of in limbo and dropping, and lenders' balance sheets and further cash in trouble. Think about what's happening in the market. We're raising interest rates to fight inflation, but we're also sucking liquidity out of the market, which is the liquidity that banks require. But whether you're talking about a bank or a debt fund has a bank behind them. They usually have a big warehouse credit line that they use to handle all their liquidity. And then that's backed by their balance sheet, by the assets that they have loans on. And the problem is when, from a regulatory perspective, when loans start to look like they're upside down versus how much they have lent on a property versus what it's worth, that can really be a challenge. And so where construction draws used to take 2 to 4 weeks, they now take 2 to 4 months plus. Ooh, if they actually fund. And so, we have 3 or 4 projects where that's an issue. And, look, it creates a cash problem. I mean, people, everyone out there, and it kind of goes into another lesson that goes with this, but, you're all taught to underwrite cash flow, right? Yeah. Income minus expenses equals cash flow, less debt service is cash in your pocket, right?
Yeah.
And there's some more nuance to that, but cash flow is well understood. You also need to be really hyper-focused on cash. Okay. Operating a business, which is what this is not just cash flow, it's cash. You can have great cash flow, but if you have no cash, you're in trouble. So the challenge with this is, if I structure a deal to, let's say I have $5 million in construction, I'm going to do to a $20 million asset, right? And they're going to give me 70% of the asset in the loan, and they're going to hold that 5 million and say, okay, well, when you prove me you do the work, I'll give you that money in pieces, right? Well, then, so you keep, let's say $1 million, 20% of your budget in cash. And so you go spend 500 at a time and you make a draw for 500 and they give it back to you. That used to be how it works. Well, now imagine you go to spend that money and you're still doing work on schedule to try to finish the project. Well, then the first 500 doesn't come back. And so you have to rework the draw. You're like, well, that's bizarre. Let me try again. Meanwhile, you're still spending money. Now you spent the second 500. So now you're out $1 million and the draw still doesn't come back. Well, now you're out of cash. You have obligation to finish the project and the lender's not making the funding happen. Wow. So that's probably been my biggest pain point, I think, in my career. That is, again, I don't think it could have been predicted because these are pretty standard products that have been used in the market for eons. But it's been very bizarre and unnatural to feel that. And I think the lesson that I've learned is, control and possession is everything. Right?
Yeah. Yeah, that totally messes up your ability to execute a business plan as well and effectively. That's you have to have cash. You have cash out, and you've got to replenish. You got to fill the cup back up. Just keep filling the cup up. That's a huge nugget that you just gave away too.
And if we get to corrective actions later, I'm happy to talk through how we've solved the problem, because it may be a good creative bit for anyone else who's experiencing that. But interestingly, it's not as common as I would have thought, but there are people who are feeling it.
Absolutely. And if you've got a value add strategy that include renovations and things are happening in the market, there's a lot of people that might be going through this. How did you all correct it? Let's dive into that.
Yeah, look, I think your biggest, Peter Linneman, who's one of our economic, people that we follow, he says it really well. He says, if you have courage and capital when others don't, you're going to do very well. Well, the problem is when there's chum in the water and fear out there, capital dries up. Like remember back in 2019, not 2020, but last year, right? Capital was abundant. You could like literally breathe and get 10 lenders to give you a loan at 3%, right? But now everyone's worried about where valuations are. So banks, life companies, all these debt funds who couldn't sell their loans to the secondary market anymore, they all dried up, right? And so imagine like you now have this cash problem where you thought you had structured your deal pretty well to get through all this, and there's no money out there. Like, what am I going to do? Go get hard money, like at 15% to fix this problem? Well, you realize, gee whiz, if I could only write the rules, I could do this better. And you realize you also have a very loyal investor base who you've done well for, who you've always done what you said you would do, and you have a good balance sheet yourself. And so what we decided to do was launch what we have called the fixed income fund, or it's a debt fund of sorts, right? And so, you can go check us out at thequattroway.com if you want to see how that works. It's a live offering. I mean, you got not poaching investors here, but you're happy to go look at how it works as an educational exercise. And the reason that it works is, okay, we have people who are looking for cash flow. We have people that trust us. And we're not over leveraging the property because we know all we're doing is replacing funding that was already planned to be used for the property, but the lender's not giving to us, right? So what we did is kind of create a debt fund of sorts where we're replacing that money they're not funding and doing it ourselves. And then, once we get to the end of the line where the project's done, the exit plan is, you can either proceed with that sale or you can go ahead and pull the draw from the lender, because at that point they're in breach of contract if they don't give it to you. Or now you've finished the asset, go refinance it to perm and pull everything out. So, but the benefit is, the key is you write the rules, right? And so we've given ourselves, a 36-month initial term, 2 free or 2 1-year extensions on top of that for a 1/4 point each on that, where we increase what we're paying the investors to kind of de-incentivize us to do it, but give us the freedom. And look, folks, you only get in trouble in this business if you run out of 2 things, and those 2 things are time or money. So as much as you can write the rules and stack your deck to not ever run out of time or money, real estate, all things can be healed with time in real estate.
Some of the most important attributes an entrepreneur can have is the ability to adapt and the sense of urgency, and to be able to creatively pivot. So you've taken an issue and you've been able to creatively create a solution that's essentially a bridge to gap, and that's what it takes. It's business entrepreneurship. It's there's always going to be another issue right after you've just solved another issue. There's going to be another one and another one and another one. And it's just being able to handle those effectively and just create solutions as those come. That's and who knows what the next one's going to be, but that's very good insights what you're giving there.
Yeah, we won't know, Josh. I mean, think back to COVID. Those of us who figured out how to do virtual showings and clean hallways and stuff like that, we hummed right along. Those who didn't faltered, so.
Yeah. And that's business too. That's entrepreneurial. A lot of newbies that have no business acumen that got into the industry, unfortunately, they'll have a lesson learned as well. Just that's the cycle. What markets are you all focusing on?
Yeah, so we're actively in the state of Texas, the state of Alabama, Georgia, Tennessee, Indiana, and North Carolina. So we really, as you can imagine, that's mostly southeastern Texas, a little bit of Midwest, really no coastal. We try to stay off coastal with the exception of Houston. We're in Houston right now. But the reason for that is we really like in those states, those are high in-migration states. They're very business friendly. They're very landlord friendly. And we typically don't focus in the main cities, so like the Atlantas or the Austins or places like that. We will buy there, but we're typically looking in secondary markets. Why?
Yeah.
Because the pound for pound is usually a little bit better. You still have good sub-market growth, but you're not fighting against the Blackstones of the world for your assets. It's more of a cash flow. It's more of a cash flow haven, a little less on the crime demographic. When you're in the big city, you really do fight the big city lifestyle a little bit, which is a challenge. And, we haven't really gone into tertiary markets, the real small stuff, just because it's typically harder to get work done there. So I would say we'd buy cash flow there, but we're not really too excited about value add plans there, because you really cannot efficiently get work done unless you just empty the building out, bring the team on site, blitz it, and lease it back up. So
yeah, secondary has a baked in path of progress. Eventually they will come. Your cities just keep growing like it should if the economies are good and the commerce is it's down the road. That's where appreciation kicks in, and you can have a great exit, or the cash flow just increases.
Yeah. And look, the best ones, I mean, you kind of hit it on the head, right? Path of progress is clear. Let's just think about the city of Chattanooga, right? I mean, it's on the interstate between Knoxville and Atlanta. It's kind of not far from Nashville. I mean, you have people say Nashville's a secondary. I think it's a primary now, but people have main, as long as you have primaries nearby, they kind of support the industry, and the industry can sit on its own 2 feet. It's usually a pretty good place to operate.
Yeah. No, I totally agree. Tell us a little bit about the feedback that you get from your investors and how Quattro handles their investors' communications and what they could expect.
Yeah, I think what I would say, and this is really important, folks, whether you're investing or an operator, that's your number one customer, right? You have residents, your lender, and your investors, and those are your 3 customers. Your lender happens to be your biggest investor, so communicate well with them. But, I'll say every investor we have has our cell phone numbers, right? When they call, we answer. Now they don't call that much. And you got to recognize there's different types of investor personnel, right? Some, every time we send a quarterly report out, and you know who you are if you're listening to the show, you call us and you get on about a 45-minute call and we go through it. And that's fine. That these are very savvy investors. They challenge us. They want to hear some things, and sometimes they have good ideas, some we really have to, they're either newer or more high level, and they really need a good, just a quick summary of what we sent. And some just read the reports, So I think it's important to communicate in different ways to how your investors need to hear it. Some you may have that type A experienced personality where they're going to need a 45-minute call every time you communicate something. Some are going to need that short summary. Hey, what's going on here? Maybe a text, whatever. And some are just going to read the standard reports you put out, but just understand you're not going to make everybody happy. But I think it is important. And that's one reason why private equity firms like ours are attractive is, there's a lot of distrust out there. And it's because, big corporate has really blown the trust of investors, right? I mean, I've invested in Apple stock before, but I can't tell you the last time Steve Jobs answered my phone when I called back. Yeah. So it's like, or do they ask my opinion before they sell an asset? No, they don't. Right? They just do it.
Yeah.
So I think that's really one of the values we bring to the table is we're super transparent, we're brutally honest, and we're always there. When people want to talk to us. And I think, if you're an operator, one thing you really have to embrace is one-to-many video messaging. So kind of like what we're doing right now, this isn't messaging, but it's a podcast. A lot of people are watching this and I'm saying it once, right?
Yeah.
Sometimes it is just better to describe things by talking about it like this and watching nonverbals and all that kind of stuff, right? An email can be misconstrued. We use tools like Loom, like Vidyard, things where you can actually do, or Zoom recorded, where you can actually do a one-to-many communication and, explain something complex in English, with the face of the company in front of the people. So I highly encourage those because that's a real good way to, get FaceTime with people, but also, let them see the genuine, whether it's concern or happiness or whatever's going on with a situation. You can really deliver that better, through either a Zoom meeting or webinar or a one-to-many video message that you record ahead of time and send out to your investors.
Yeah. People can feel your energy, your excitement, your vibe. Totally agree with that. 100%.
Yeah, absolutely.
So for an investor or an operator that's wanting to get into real estate and get active, how would you recommend that they start their journey?
So for an investor or an operator, look, we have a lot of things available to us that we didn't even 5 or 10 years ago, So the first thing I would do is recognize that real estate investing, if anything sounds easy, it's too good to be true, and it probably is, right? So, I would say start with podcasts. There are literally thousands of real estate podcasts out there, including this one and ours. And, all you have to do is Google real estate, or more specifically, if you want multifamily real estate or industrial real estate or office real estate, whatever, just, search for that in podcasts or on YouTube, and you're going to find a whole lot of stuff, right? Now, that's not really going to be organized in any way, but you're going to find a lot of free content that you can focus on. Like, all right, what's this all about? And you can get there pretty quickly if you're a good sponge. Beyond that, I'm going to recommend books. I mean, there's a tremendous amount of books in whatever. I mean, I have a huge bookshelf on it's off screen, but with a tremendous amount of books about real estate and different types of financing and all that kind of stuff. Start resorting to buying books next, and that you're going to get really savvy in a lot of those areas. And if you think you want to learn how to tactically do this stuff, there are boot camps and there are mentorship programs and any big name out there, I've been through all of them. They're all great, right? I mean, they're all expensive, and they're all going to, sell you packages, but the content's good and it's relevant. And whether you're an investor or whether you're wanting to be an operator, you can really, if you're an operator, you need to know how to evaluate and operate and all that kind of stuff. And these programs will teach you that, at least the 60% that if you do it wrong will land you in jail or lose the asset. Yeah. If you're an investor, you need to know the same stuff. Like, you need to know, when I throw a pro forma up on the screen, like, how do you know if it's BS or not? You know,
Yeah.
how do you go to a certain couple of numbers and say, well, okay, that's about in line, or no, that's complete fabrication? Because I'm here to tell you, you know, all models are wrong. Some models are useful, and I can make a spreadsheet say whatever the hell I want it to say. Right.
Yeah.
So you have to be able to judge the integrity of the operator, and make sure that they're not, you know, being too aggressive versus your tastes, you know.
Yeah.
And so that's just kind of a couple of ways. If you're going to operate yourself, I would recommend doing one of two things. Start with your own money, like we did, if you have the capability to do so. And you might need a loan sponsor to kind of, you know, because when you're starting out, you don't always have the assets and liquidity that are qualify you for loans. So there are people who will just kind of kiss the paper for you. And if you're, you know, if you're looking to operate, I would recommend partnering up with someone who's done it before, at least for your first one. You know, like, find a way to add value and get on a team and do it that way. Don't expect to make a whole lot of money on that deal where you're kind of the newbie coming in, but you know, just work to learn, and rather than work to earn first, and then you'll be able to do your own stuff.
I like that a lot. That's we used third-party property management to actually help get approved, but we were and just soak up what they're doing and learn from them, and just be a sponge, be there to help and educate yourself. It's huge.
That's right.
Real quick, what are your thoughts on the current state of the market and where it's heading, and all the good stuff that we see out there?
Yeah, look, we could do a whole episode on this. So, you know, we'll see how verbose you want me to be on this. But I mean, look, how did we get here? You know, we printed a whole bunch of money in COVID. I'm not arguing that it was needed, but you know, there are consequences to increasing the money supply. Almost, you know, 2 years later to the date, we wound up with massive inflation, which kind of makes sense because the supply chain started to recover and people started to buy stuff, and they had a lot more money in their pockets, and they paid what they had to pay, you know, and that's simply how it worked. And so, you know, what did we do last year? The Fed decided to jack up interest rates at a rate faster than they have since the 70s. And that's a 50-year event, if anybody's counting. And also started sucking liquidity out of the market, or sucking cash out of the market, you know, to try to bring that down. And I think they've been successful. You know, the argument is, you know, whether or not you include certain things or others in the indices. But I think, you know, by a lot of economists accounting, we're kind of already at 2.5%. So I think we've achieved it. The question is, will the Fed continue to drive the stake into the ground, or will they kind of pause for a while? You know, look, where we are, there was a massive run up in real estate. There really was, and other assets. Anytime money is cheap, you know, and being given out, you know, it will find its way into banks. I mean, think about it. When you get stimulus money, what do? You go deposit it in your bank account. Well, the way banks work is banks, you know, they have a very unique status in life where they can lend the same dollar that you put in there out to 10 different people. You know, it's a 10-to-1 reserve ratio. And the theory behind modern banking is that, you know, only 10% of the people ever want their money at one time. And that's why you see some banks fail, like in Silicon Valley Bank, when there was a run on the bank and everyone, more than 10% people wanted their money. Well, the bank doesn't have it. So they have to go file bankruptcy and insolvency. And so, you know, I think where we are, that, and that kind of drove a lot of cheap debt, right? Because all that money went to banks. Banks said, hey, I've got more money than I know what to do with. Let me, you know, rates are low. Let me just get it out. So all this cheap debt went out. You know, I think if we bring it back to real estate, you know, and the consumer is still pretty strong on average. You know, like they think about home buyers. A lot of people, like, I think 65% of the country owns a home, give or take. And, you know, about 90% of them actually have sub 3% mortgage rates. So there's not really going to be the massive home crisis I think we saw. There haven't really been as many, you know, subprime or variable interest rates, you know, to date. But then you turn your attention to the commercial real estate market. And now we're questioning, okay, well, how are renters doing from an operational perspective? Well, I'm here to tell you, if you're operating a building that is, you know, pretty old and probably Class C or below in nature, you're probably struggling a little bit to collect because that resident is running up credit card bills. They've been hit the hardest by inflation. They're already paycheck to paycheck. So when eggs go from $2 to $10, that's a big deal, right? And that stacks up. And you know, let's be real. There's been a lot of value adders in the space, and a lot of markets getting, you know, or a lot of properties getting marketed as value add 2 and 3 times this cycle, right? You know,
Oh yeah.
so when that resident is paying, gosh, 45% rent to income ratio, like you're going to start to have collection problems. You can probably get the rent, but the ability for them to pay is hard. So there's kind of a split in how residents are doing. I'd say the upper class ones are doing pretty well. You know, the ones that have the white collar jobs and salaries are increasing and they're able to keep up with it, versus the ones who are, you know, a little more paycheck to paycheck and not, you know, having as good of a time. So your operations are probably dependent on what you own right now. I think the elephant in the room on commercial real estate is taxes and insurance. So depending on where you are in the country, Texas, for example, say taxes in Texas 5 times, it'll make you as crazy as it is dealing with taxes in Texas. They chase sales. And so there's a lot of, you know, you think about it, how does the government make money? And well, the states can't print money. The federal government can do it. The states cannot print money, and they get their revenue through things like sales tax, property tax, things like that. So you think about Texas, where oil, sales tax, and real estate are the 3-legged stool, you know, and guess what? Office buildings are still struggling in Texas too. So that revenue's down on the taxation side. They're trying to make it up elsewhere. And so you're kind of seeing some of that, that burden of how to run the government pass all the way down to the property owner, down to the tenant. So those are tough. And then where do we go from here? I mean, look, I do think the lenders kind of learned a lesson in 2008 that, okay, I don't want to be so quick to take back a bunch of, you know, distressed assets, because that'll really blow up a balance sheet and cause a global economic recession. You know, I think what's likely to happen is if you have a loan maturity coming due, or a loan is not performing, it's more likely to get restructured. And so, and look, the lenders are going to pretend they have all the power until you say, all right, buddy, here's your keys, go on, do your thing. They're like, no, I don't want it back. And so that's where they're going to start to work with you. So just, I mean, no, I'm not saying give the keys back to them, but I'm saying, you know, be a little more aggressive with your lenders right now, because in a lot of cases, you know, you do have some leeway, you know, to renegotiate things, just because we're in a massive 50-year event. But there is going to be pain. You know, I think the office sector is still, like, even when it normalizes out, it's probably going to be best case 75% occupancy where it was. So, you know, the upper class office will do fine eventually. The lower class office, the older stuff, will probably get converted into something else, maybe housing. You know, I mean, I've seen some articles about that. But you know, that's going to be the big question mark, is what happens with all these loan maturities. In multifamily, and the last point here, Josh, in multifamily, I haven't really seen a tremendous amount of distress sales, right? I've seen some pain, and I don't think the pain has gone on long enough. It's only been about a year. But I think there's a lot of people really holding on for dear life, maybe making a capital call to cover negative cash flow, and just saying, look, this is projected to be a pretty short-lived recession, is because of the speed with which we went into it. Yeah. And I mean, I'm not arguing if we're in a recession or not, but the speed with which we raised rates is going to require the speed with which they come down to whatever the new normal is, to re-stimulate growth and ease the pain, right? It's just a chokehold on the economy. You can't let the economy black out. So, you know, I think there's going to, you know, the cap rates are slowly rising. You know, I think we've gone from about an average of 4 to 4.5 for a multifamily deal to 5.5 to 6. And so I think, you know, there's some good buys out there. If you can, you know, afford to get into the basis and kind of marry the basis, but date the rate, if you will. And then from there, you know, I don't think we're going to see massive fire sales unless we actually break more glass in the banking system. So,
yeah, I totally agree. We don't know what they've got on their crystal ball, but
that's right,
we shall see. Very cool. Chad, put a plug in here to let everyone know how they can get a hold of you.
Yeah, I appreciate that, Josh. So the best way to find me, I have a little link called chadsutton.info. That's CHADSUTTON.info. That will take you to all things related to Quattro Capital, our offerings, our podcast. We have a show very similar to this called Real Estate Runway, where we put out 2 episodes per week on, you know, interview style, just like this, passing some good nuggets on real estate investing and such. So check us out there, and we are all over social media. So wherever you want to integrate, just go to chadsutton.info, click on your favorite social media platform, follow us, and we'd be happy to, you know, continue the conversation there.
Very cool. Chad, totally appreciate your time today. A ton of nuggets. Look forward to following you, and we will certainly talk soon.
Yeah, brother. Appreciate you.
All right.